Yardi Matrix just releases their January 24 National Self-Storage Report. That and much more coming up today here on the Commercial Real Estate Report. I'm your host, Chris Berg, Head of Business Development for Abernathey Holdings. We go out and we build Class A self-storage sites in California and Arizona. I'm very excited. Joining us today, President and CEO of Abernathey Holdings, Andrew Abernathey. Andrew, great to see you again, my friend.
Hey, thanks for having me on. I'm really excited and I appreciate it.
The timing couldn't have been better. You and I are like, hey, let's talk about X, Y, and Z. And all of a sudden, yesterday, I find this brand new Yardi Matrix National Self-Storage Report. So I'd love to know from you, what was the most important data point or best thing you got out of this report?
I think it just kind of reaffirmed a lot of the things that we kind of assumed was happening. I think the rental rate declines kind of bottoming here. I think, we found a pretty solid bottom. Like Phoenix has one of the largest declines over the last 12 months, but had actually an increase month over month. So I was excited to see, abandoned sites over 1,500. Not surprised. Again, that is a bullish case for what we talk about, maybe a lot less supply in 2027 and beyond. So again, that just kind of reaffirms that. Then you got deferred sites. 90 plus of those. I'm surprised actually that wasn't a little bit higher. And I think it could be higher. I mean, at what point is it considered deferred? I don't know. I'd be curious to know that. So no, it's everything kind of I expected. I'm glad we can see the bottom now. And it'd be interesting. 24 is going to be a really interesting year.
So let's just talk a little bit more about your thesis suggesting, hey, this is the bottom. Why do you think that's an accurate statement?
Yeah, you can just see in the rental rates, they've come down quite a bit, and now you can kind of see some stabilization. Now, one of the biggest clients in self-storage is people buying and selling homes. I'm not saying that that's going to be back to gangbusters by any means. Depends on interest rates, but the new normal interest rate, maybe it comes down a bit, but the new normal, people will get used to it. They're going to be buying and selling homes. I don't know. I think I'm not saying it's going to all bounce back to where it was. I think this is a new bottom, and I think we'll just start a nice gradual to our next peak in however many years, and there'll be another one, back into the cycle. It's a lot easier to underwrite properties once the curtain's already been dropped, right? I mean, underwriting stuff when rental rates were a lot higher a few years back. Well, that property and that site doesn't look as good as it did then now. So it's just, again, I feel like we're pretty blessed to be underwriting now instead of then for a lot of sites.
Let's dive a little bit more into specifically Phoenix. You live there, you've been there now for several years. I think one of the interesting data points, as you mentioned, is you saw probably one of the biggest decreases in rates and climate control in Phoenix year over year. And yet, as you just mentioned, month over month, it was the one city that had the highest increase in rates. So is it a seasonality thing from that standpoint from December to January? And what else you've seen in the Phoenix market?
Phoenix market, whether, and I'm just going to be broad with it, where the rental rates have dropped to and where the cost for sites still is and the cost to build still is, it's really tough for us to achieve our yield to cost goals in Arizona. We found a few sites. We've got about 4, I'd say, 2 under construction now. We'll break ground on the other 2 this year, next year. And, we're just not seeing the deals as available here just for those reasons. You're just not, a yield to cost here at 7.8% is probably about as good as you're going to find. Well, our goals is 8.5 to 9% yield on cost, just with where the 10-year and the cap rates at where it could go. So, our California market, Chris, well, out there, every deal you find that works, whenever you can get dirt for under $2 million, you get rental rates for $2 plus. Keep them coming. I'll have more of those, please. So.
We don't have to wear secrets.
Yeah, that's a good point.
There are a few of those deals out there that we are hunting down. We'll talk more about that.
Yeah, no specifics.
Yeah. Do you think part of it in the Phoenix situations, because it looked like, I think Phoenix was the 4th highest as far as net rentable square feet coming online over the last, 36, 12 trailing months.
Yeah.
So you've got that with more supply coming online, lack of people moving. Is that what you sort of attribute this decline in rates to?
Yeah, I mean, it was about 11.4%, I believe, the last 3 years of new supply. I think the last 12 months was 2.4. So if you take that 2.4 times 3, I guess you're lower than the 11.8. So that's a good sign if you take it times the 3. But yeah, I'd say between the lack of moving I'd say between, there's a lot of supply put here, but again, this is a micro market business, right? It's 2 to 3 mile radius. So I think what we're going to see is you're going to see those underserved little micro markets that we're going to get our hands in on. You just got to wait for those right sites to come up. In Arizona here, just like in California, we kind of give our brokers somewhat direction on like, hey, here's a pocket. It's missing some supply. The rental rates have stayed steady. I mean, this was a great test for any site or any lot you're looking at. Like this site over here, the rental rates drop, crazy. And there's sites that we actually had to back out of just because rental rates dropped so much and it didn't work. So we backed out of them. So again, it's a micro market, but I would say the lack of moving and then a lot of supply added to the market are the two things that have kind of hit it hard here.
You can get as specific as you want on this, but I know that there's a site in Arizona that we currently have got under contract, maybe been closed on, and yet now the appraisal is coming in. Let's just say there's a discrepancy. So tell us more about that.
Yeah, so we had a site, one of our first ones, the appraiser came in a couple million late on an roughly $18 million project, and we're going to move forward on it regardless. It's a great site. And we're going to go back to the appraiser. I think they had there's a few things on there I think that we disagreed with. So maybe we get it up $1 million. But again, those are the things that, we're well capitalized for a lot of reasons. But this is one of them. Because if let's say they're $2 million light on the appraisal, let's say we get them to give us back $1 million, that $1 million has got to be pure cash, plus our down payment of roughly 35% on the rest. So these are the reasons where it's nice to be, flush with capital, a good JV partner, good banking relationships. Because this is a project that most people wouldn't have been able to do, and we're going to do it, and we're very, very bullish on it.
So I brought that up because I think what's been fascinating, and I'll just sort of lay this out and let you speak to it. But as I mentioned to you, I put it out on Twitter and shared that with you, where I talked to a broker this week, and he told me, hey, over in Rialto, you had stuff going at $100 a square foot. Now you probably get it at 60. You had a piece of dirt online for $15 million they came out at. They got an offer at 11. Guys just pulled it. There's another site that we've been looking at where came out of the gates at 2.3. There's an offer on it at 1.3. It looks like it's going to be taken. There's another site we're looking at where it came out at $13 a square foot. They got an offer at 15, and now they're probably going to take 12 on it. So just want to get your assessment on, especially based on what you and I have studied and talked about with the real estate cycle. What do you make of where land prices are going at this moment here in some of these areas?
Yeah, I think like in Arizona, something's got to give. For example, in California, things make a little more sense, but there's still drop. Like you said, the one site was 15. We lost out on it. We just about to get into contract here for, call it $12, right? It works at that. In Arizona here, for example, if rental rates are X and interest rates are X and cost to build is X and land cost is X, well, all those X's have to add up to be to that yield to cost that we need. So something has to give, right? Let's say interest rates maybe give a little bit. The construction costs are probably going to plateau if anything. I mean, the land cost is going to have to give. The rental rate's going to have to come up. So it's going to have a game of chicken, I guess. You have to have a motivated buyer and a motivated seller. Well, motivated buyers, there's a lot less of those. And even the ones that are motivated like us, it's still got to make sense. So I'm going to say the landowner's probably going to lose the game of chicken. Now, what does that have to drop? I think, again, it's a micro market answer. The rental rates that in our area that went from 180 to 140. I mean, that lot's got to go down quite a bit. I mean, there's some dirt that just doesn't even work for storage, no matter if it was free at the current cost. So yeah, I think landowners that are motivated to sell, they're going to have to bend to make their number work, since all the other X's are kind of out of their control, and ours.
Yeah, you bring up such a good point where, I think there's some landowners out there that they're like, hey, you know what? We don't get the number we want. We'll just, like these guys down in Anaheim, we'll just take it off the market and no big deal. So you got to really find that right opportunity and a seller that needs to sell, which is one of the reasons I mentioned the 1.3 offer on dirt that was 2.3 may take place. I want to go bigger picture for a moment with you, because you're a numbers guy. You've studied the real estate cycle like I have. You know that, in fact, the Wall Street Journal's got a piece coming out, $2.8 trillion. I mean, it's an exorbitant amount of CRE. Yeah, $2.2 trillion that's coming due in 2028. You talked about one of the sites where the appraisal was $2 million less than we thought. Where do you see things going in the next, let's say, 18 to 30 months?
You know, I talked about this last time where, I see the 10-year bond hanging out in that 4 to 6%. And we're there again. It dipped below 4% a little bit there for a while, but it's back in that 4% again. There's just so many bonds that are going to have to be issued to cover our deficits as a country. That's going to require a little bit higher interest rate to entice the buyers. So, I think cap rates have floated up some, and again, it depends on what asset class we're talking about. You got storage, you got hotels, you got office. I think this is going to, what do they call it? I heard it was a balance sheet recession, which I can understand that. Even if you don't default, you're still going to have some hits on your balance sheet for valuations and appraisals for refinances and higher interest rate. Your cash flow is going to be, even if you can get something refinanced on a property that you bought at a lower cap rate, now you got to refi at a higher interest rate. Your cash flow is going to be a lot less. So I think but there's also on the side, there's a lot of cash on the sidelines too. It was 8.8 trillion or something. It was on the sidelines. So again, where that's going to be spent is who knows exactly. But I think there's going to be a lot less buyers than there was the last 3 years. That's 2-3 years ago, which is good for us. I think investing is more about temperament than IQ, right? Like you don't need to be able to play 3D chess to be a good investor. So I think that's the biggest thing is that I don't know exactly what's going to happen. Nobody does, but I am bullish on, I think there's going to be a lot less buyers than there was during the euphoria years. And that excites me. So as long as we have that temperament, discipline, and the capital which we have, I think the next 3 years are going to be a lot more fun than 2020 to 23 with those scenarios for us personally. So,
I don't think I've ever asked you this. I'd love to get your take on what do you like about California? I don't know if you've had this experience. If you have, please share. But I know for myself, like when we were at ISS last year in Vegas, and I was just on my way out to Cali, and we would be talking to people like, yeah, we're going out to California. And people would literally laugh. Like, you're going, where? Like, what are you thinking? That's a crazy place. And yeah, it's been great for us. And so I just want to get your take on what do you like? What do you love California for us?
Any business or investment that I make, I always look for a barrier to entry. I like things that are hard to to be a part of. So like, for example, HVAC companies. My father-in-law has one, and I know one of the struggles with that company is the second someone is really good at it, they can go get a pickup and put a name on the side and open their own business. There's really no capital. It's not a capital intensive business, right? There's no moat around that. Now I know you have brands and all these things, but it's really low capital intensive. Real estate's nice in general because it's capital intensive. So that helps. That's a barrier. So I look for barriers. I also look for barriers in entitlement. If you're in the development business, if it's easy to entitle, quick to entitle, well, then everybody's going to want to do it because there's a lot of money in the world. There's not much patient money. So I try to stick in the room of patient money because there's a lot less competition there. So back to California. California has high barriers to entry. Sometimes it takes longer to zone. We haven't really seen that, but I think that's because people look at California as just one thing. Like, oh, California. Okay. It's 45 million people there. It's got one of the largest GDPs for most countries if it was just its own country. But Fresno, Moreno, that's a lot different than LA and San Diego. Like Fresno land, similar to here. Entitlement process, similar to here. Actually, it's like an egg community. It's kind of like Fargo, North Dakota, where we've come from. So California is such a broad brush. I mean, there is different markets within California. So I love that people are afraid of it. I love that because that's good for us. I love the barriers to entry. And then also, yes, they have some crazy laws there. We know that, like tenant laws and all this stuff. Storage is the best asset class to ever have in California because you get the rental incomes, you get all of those things, but we don't follow tenant law. Somebody's on pay, we overlock their stuff and auction it off. We don't have to follow those crazy laws. So would I want to build apartments there? I don't know. I'm not in the business, but probably not. But storage, yeah, sign me up.
So well said, because I remember, again, before I got out here and we had some conversations just talking to different brokers, And there was a couple conversations that you and I had with people that, made us choke because they're like, oh my gosh, it's going to take you 36 months to get it done. Now, knock on wood, but Fresno's been
Yeah,
fantastic,
humming
right?
along.
Yeah, I mean, and you look at the timeline there, and it's like you said, it's just like I'm presuming like Phoenix, yes.
Yeah, very similar. I mean, Phoenix is, I feel like it's the same as California when it's comparing the sites we're working on here and there. I mean, Arizona is not that easy. I think that's probably changed a lot the last 10 years. I can't attest to that because I wasn't building here 10 years ago, but I don't think it's much easier than Fresno and Moreno. Now, again, comparing to an LA is probably a lot harder. We haven't done one there yet. I'm sure we'll find out someday because we always get curious. But, I'd say the biggest risk we have there or anywhere would be property taxes. That's one of our largest expenses. So if property taxes come up quite a bit in California, but the thing there is, as long as we are in low competition areas, we pick the right sites, we should be able to charge the rents to, overcompensate that extra cost and property tax increase if that happens. But
Boy, thank you for bringing that up. I've got a conversation later today with a big land and zoning attorney here in LA. And one of the big topics this year in 2024 in California is a thing called the Taxpayer Protection Act, which will hopefully get rid of what was called the ULA or the mansion tax in LA, which has been really punitive on, our asset class, multifamily, all kinds of stuff. So last question for you is that, one of the things we're looking to do is find really specific kind of brokers that want to partner with us, be teammates, and go out and build a really beautiful real estate business. So if you get a chance, if you can share, kind of who we're looking for and what's in it for them to be a part of Abernathey Holdings.
yeah, so Abernathey Holdings it's bigger than all of us, bigger than me. That's the goal. We've created this atmosphere, this company that is owned by, I think we've got 82 owners at this point. It's really well set up when it comes to it's an LLC. It's a Delaware Incorporated LLC, and you've got all these investors come in and buy shares. Well, that entity then now owns all the real estate. It owns the construction company. It owns the garage door dealer discount contracts we have. It owns all of these things, and it shares it pro rata share for the shares acquired. And then there's not somebody in the middle taking profit share and all of these things. Everybody just works as an employee, gets a salary, and then we get the upside of our shares. So what we've done is, we've welcomed passive investors, of course, but when we find great brokers that want to work with us to find good sites for years, decades to come, we've extended the offer for them to buy shares in the holding company as well. So they can have a part of everything we have built, everything we will build, all the vertical operation companies. And that's worked out really well. And at $75 a share, we like people to invest at least $50,000, but it's approachable. You get commissions on a site, pay your tax, you might turn around and throw a little bit back in to have some ownership in that property and everything else we're doing.
So just so brokers can appreciate what he's sharing, you're going to have access to obviously be equity owners in sites in Arizona, California, as we continue to build our footprint, the other auxiliary businesses that we have in the holding company. So great opportunity, I think, to build some equity and also just partner up with us and say, hey, it makes sense for me to keep feeding you guys deals because it's only going to help my units or stock, if you will, grow as well. So, anything else you want to add or share there, Andrew?
No, yeah, I mean, we are a family of partners, I like to say, and we're all just have the common goal of building this thing bigger than all of us, and the wealth will be trickled down and shared accordingly. So it's just really exciting, making money for good people. That's sounds cliche.
It's fantastic, right?
Yeah.
It's sort of like, I don't know if you've seen, I think it's called Good Profit, that book by the Koch brother who put out a really good book on that. So, and you mentioned decades. So just to help people appreciate where we're headed as an organization, kind of lay out that vision that you see.
Yeah. I mean, I skip to work every day. So, I mean, I'm going till I'm 90 plus, assuming I have the honor to live that long. I'm never stopping. And we've created an entity where people can come in and ride as long as they'd like. And then we always have shareholders ready to acquire shares if they're, we've got, I think the last 7-8 months, there's been $4 to $5 million in shares that have exchanged hands from old shareholders from 10 years ago that are now wanting to retire to new shareholders. So, there's never a guarantee, but we've never had anybody that, wants to get out for retirement reasons and couldn't. I'm here forever. And if you invest, you can join me forever as if you wish as well. But it's a good long-term mindset company, good values, and again, nobody taking that profit share off the top, hurting your returns.
It's one of the things I appreciate, our conversations. You talk to Gary as well, Gary Thurlton, our JV partner, and he always says to us, guys, these are 50-year assets. Like, keep that in mind. So it's definitely not a short-term, quarter-to-quarter, typical thinking process you see maybe on Wall Street. So,
Correct.
Andrew, as always, man, great job. Appreciate what you're doing, and we'll give you the last word.
Yeah, well, Chris, thank you. I mean, like I said, California's been our best market at this point, and I appreciate you having me on. And we're just here to continue to learn and make the deals that make sense at the time and have long-term outlook, stay cash liquid, have good relationship with banks, brokers, and I don't know, it works well.
Just keep on rolling. So thank you for joining us today here on the Commercial Real Estate Report. I'm Chris Berg. We'll see you next time.